Ayy, breathing again. Some gon' leave like trees in the wind. Well, y'all gon' see like B to begin. That BC days, y'all free to pretend. Ayy, cap on the internet, rap, we ain't into that. Fact, I'ma interject crazy. Ayy, whack, I'ma intercept that with the intellect. Chat, better give me that gravy. Ayy, that mean chicken. Gotta blow that, get it back, never know the cost. Yak it, get it black, and a few stacks, never gon' lack any cobras, dog. Ayy, I don't got a cross for the NBA. I seen Tobin, the all-white promo vid. And if God be for me, I ain't got a mind to against me. Ayy, shoot the shot like I'm Curry. Ooh, I don't cap for my pictures. Ooh, narrow way, but I'm sturdy. Yeah, I don't pass on the scriptures. Ayy, walk with it 4 seasons. Never going back is no reason. Devil trying to tag you, throw demons. I don't never lack, I'm pro defense. Double check y'all Twitter feeds. It's a whole lot of big cap, like a biz hat, no ministry. It'll wall fall like winter leaves. And if you don't got Christ in the middle with the bread like a centerpiece, you'll probably gotta retool. No sheep food, so hard for the inner piece. All cap like Captain America. Capsaicin and capture the area. Cap crunch, cap marvel.
What's good, baby? It's your boy Dale. I'm back in the saddle again. Our motto is to buy, build. We already bought it already, so we already own it, free and clear. Refinance to long-term debt, cash flow. That is the motto. Cliff, man, is that a pretty strong motto, man? What do you think?
Man, the model is strong. Like, you're getting each piece of the invest, right?
What it do, y'all? It's your partners Dale and Cliff back in the saddle again for another edition of Real Estate Friday Live. We began a little bit late today, guys, because we have been talking some business, man. Cliff, how was everything going, man? How's everything going with you, man? Everything doing well?
Man, doing okay. It's been a up and down week. Yeah, I told Dale to let y'all know, lost my grandma this week.
Yeah.
So it's been a little bit trying. So family calling and having those conversations, but she lived a long time. It was a blessing to have her.
Yeah.
And so that obviously made this week a little bit more, but she lived a long life and definitely very blessed to have her in my life, man. But it's the business side of things is still rolling, trying to get that done. Man, got the bag, boy. Got the bag.
Yeah, so we got that bag, man. We are praying for you and the family, man, during this time, Cliff, man. I know this is tough, man. Just kind of be transparent. A good friend of mine, she lost her dad on Sunday.
Oh, wow.
From cancer. Actually, kind of get to give a little bit of some back story. It was Kirk Franklin's sister-in-law. Her and I are pretty good friends. And I actually took her to my high school. It's just as friends. And her dad, he told me we at the local church, and we in the middle of the auditorium in between services because I was in the youth choir. And he said, "Son, I want my daughter home by 11 o'clock, not 11:01, not 11:05." And my dad is sitting right there like, "Dad, handle this lightweight." My dad said, "You better listen to this man. Listen to this man." And I was like, "Oh, okay." Cliff, she said she was back at home at 10:45. 10:45. Yes, sir. 10:45. Yes, sir, man. But it was cool. But he passed away, man. Elder at a Oakland Bible Fellowship, man. And I probably ended up going to his funeral when they actually have it at the local church. He was the first Black captain of the University of Colorado football team.
Oh, okay. Wow.
Didn't know that at all. They released a press release for him as well. He was a chief executive for one of the chief executives for Xerox. Very well accomplished man. Yeah, good guy, good man. But man, praying for you and family, man.
Yeah. It's definitely a tough situation.
Yeah, but we did get the bag too. I got the bag too. Now, guys, if you could, guys, like, share, and subscribe. If you don't mind, if you like what we're talking about, man, subscribe to the channel, baby, and click on that little bell right there, guys. So when Cliff and I come live, you can come kick it with us, y'all, real quick, guys. So Cliff, man, before we get into our topics today, guys, Cliff, real fast, brother, give a current market analysis. We haven't done this in a long time. So Cliff, man, give them a current market analysis, man. I'm gonna actually put some music behind you too, Doc. So go ahead and give let them know what's going on. Go ahead, brother.
Man, this is the market is different. It's stagnating a little bit. It's going sideways, especially I'm trying to see in luxury. Luxury is going sideways a little bit. it's really not picking up as much as I've seen before. You still got the bottom of the market that's strong, like usually about 300,000, still strong, especially the DFW.
Yeah.
So starting to see that pick up a little bit, but most of the time I'm seeing longer days on market. I'm seeing huge price cuts across the board. There's just not a lot of buyers in there, especially at the higher price points. And until the interest rates get cut, we're not going to see a lot of movement.
I agree, Cliff. It is the cost of capital being so high right now in every market. In every market, this is not just in certain markets. This is in every market. The cost of capital is so high, guys, right now. People manufactured pay raises with credit card debt, guys. It's hard. People's DTI is high right now. But the one good thing that I am seeing is price points are coming down. Those unwise sellers are finally beginning to see a little bit of the light and cutting down price points. I'm seeing 5-10%, Cliff, and I think it's going to go down at least another 15% to where it'd be at 25%. You see the same thing?
I mean, that's a pretty dramatic cut. I mean, it's possible. I mean, the only people selling right now are the people who have to.
Yeah,
it's just not. It's been a weird market since the pandemic. When they raised interest rates and doubled them in 1 year and then held them there, the market has not been the same because you have 70-80% of the market at 3 and 4% interest rates, and now you have people buying in at 7.
Yeah,
it don't add up until the market gets down to maybe closer to 5.
Yep,
you're just not going to see anybody move or change.
I agree, guys. And we're going to talk about a little bit more about the rates in a second, guys, when we talk about Powell and Trump real quickly. But I don't see movement with the rate until Powell's out. I don't see it, unfortunately, guys. So if you're waiting for him to do something, it don't happen at all, guys. But yeah, man, that's kind of the current market analysis of what's going on, guys. But guys, real quickly, it's what it is. Is what it is. So you guys come for us for this. So we got it. Now, let's go to our first topic, guys. Let's go through all the topics real fast. Here topics, guys. We talk about no rate cut from your boy Powell and the damn board. Another non-rate cut, guys. Number 2, Trump unleashed he is not happy at all. At all. At all. Number 3, the media responds and reacts, brother. We're going to talk about how this is going to impact buyers, sellers, and investors, guys. Let's go to the first topic, man. Now, y'all get ready, man. Cliff is finna go fire and brimstone on this one, guys. so how the market moves, guys. This Fed's decision to hold rate steady. I thought it'd be wise for us to bring in our guys from Valuetainment real quickly, guys, so we can see what's going on, and they're going to talk about all this for us. Let me get this right, y'all. There we go. It's right, guys, real quickly, and we're going to hear them talk about it and talk about what Trump actually said. Let's dive into this thing. Here we go.
The Fed holds rates steady for the 5th time this year, but some officials think it's the wrong call, okay? So this is President Trump's best friend for the last week. They've been kicking it together, all right? They've been looking at properties of spending $3.1 billion on it,
of course,
patting each other in the back.
Hard.
Finally, we saw a little bit of Powell's personality by putting his tongue out. Did you see when he did Did you see when he did that or no?
No.
Very awkward. But you saw the child side of him. He acted like a 12-year-old. It was interesting. First time ever. Here's Powell giving some good news to nobody.
My colleagues and I remain squarely focused on
Not your
achieving
colleagues,
our
just
dual
say you.
mandate goals of maximum employment and stable prices for the benefit of the American people. Despite heightened uncertainty, the economy is still in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has come down a great deal, but has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen, and we believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments.
Okay, so
listen, I'm not in a.
So Cliff, man, let's okay. We're gonna hear what Patrick has to say, guys. But Cliff, actually has he has a special place in his heart for Chairman Powell. So I'm gonna go ahead and cue up the music for Cliff. Okay, he's gonna go. I'm gonna let him loose. So yeah, y'all get ready, because let me bring Patrick back on real fast. No, I'm not. It's just gonna be Cliff. It's gonna be Cliff. All right, Cliff, man, go ahead, brother, and give us your thoughts on the Fed chairman and go.
Man, I didn't know there was gonna be music on today. Yeah, throwing some music on. Now we got, trying to change the mood a little bit. I got you. Man, Powell, man, I've been talking about him for a long time. It's been over a year. When he was raising interest rates, why did he raise interest rates so fast? Because he was slow. He should have done it earlier. If y'all watching this podcast or listening to the podcast, watching, however you're doing it, if you would have listened to us, we were saying they need to raise the interest rates earlier because we saw inflation coming. We saw it was hitting 3, 4, 5%. We're like, you need to do something. They said inflation. They said it was basically they said they was transactional or transitional.
Transitory.
Transitory. They said it was transitory. Wrong. One transitory went all the way up, I think almost 12%. Then once we finally get it under control, you look at the interest rates, it's high. We all agree it's high. He says, well, the market's still okay. Well, then why did you raise it this high if this rate that you're at is okay? You didn't. You raised it this high to slow the market. That was the point of the interest rates being this high. Correct. To slow the market. Now that the market is now at equilibrium, lower it back down to where we have a normal market.
Yes.
His dumb ass said no. I'm gonna keep it high. Why? Why would you do that? You know it's high. You did it on purpose. So every time he talks, he changes his mind. And I mean, it's like nobody's listening at this point. He's talking and ain't nobody listening. That's how I feel. He ain't saying nothing.
Yeah, I told y'all Cliff's gonna come with the pain. Now it's my turn. This guy's trash. He needs to get fired yesterday. He is being political, 1,000%. He is. Cliff and I can do a better job than he can because he's just projecting. He's saying, well, we believe that the tariffs are going to cause an inflationary effect. Well, Cliff, I looked it up. There's been 6 meetings of the Federal Reserve since Trump got in office. 6, right? All 6 times, this counts the last time, there was no cut. Now watch this, Cliff. I looked up the inflationary rates for when Trump got into office, the month after that, right? That second meeting, the inflation rate was at 2.3%. I also looked up and I said, when was the last time he cut the rates? It was September of last year and November of last year. What were the rates, Cliff? 2.7 and 2.7 in both those time frames. He cut a 0.5 point at 2.7 in September and another 1/4 point at 2.7 in November, right before the freaking election. What was the inflation rate the second month that Trump was in office? What was it? 2.3. Why did this bastard cut the rates then? 2.3. Didn't do shit. Right? And then we come back now, Cliff, last month and but the last 2 times he's actually had the meetings with the Federal Reserve Board. What was the rate? 2.7% CPI. That's what it was. It was 2.7% in November of 2024. Why did this bastard cut it? Why did he cut it back then, but he didn't cut it this time? Why? This guy's a train wreck. He trash. He's horrible. Dude needs to be fired yesterday. Unfortunately, the president can't fire him, unfortunately, because of the Federal Reserve Act. Repeal that damn act. Trash ass act. Garbage. This nigga's this. Okay, my bad. Now I'm getting the third time.
You slipping. You start getting. You goddamn going. He's slipping out here.
It don't make no damn sense, bro. Come on, Cliff, bro. 2.7%, bro, in November. It's been 2.7 the last 2 meetings, and you ain't do nothing. And all you've been saying is we believe that the tariffs is going to be inflationary. We have enough data to say you wrong. It ain't been inflationary. Am I right, Cliff? Am I wrong?
My whole thing is, wait a second. You're saying it's inflationary. So hold on a second. You're projecting if it's going to be inflationary, and then reacting to that, saying I'm not going to do anything. That's my reaction. I think it's going to be inflationary, so we need to keep it high. But when it actually was high, you did nothing. You didn't act. So hold on a second. You don't act when it actually is inflationary, and then when it's not inflationary, you also don't act. So you don't do nothing.
This nigga is, I'm gonna say this nigga trash. He garbage. He garbage. He needs to go. He needs to go. This is all political. I said it. This is political. There's nothing financial behind the decision. It's all politics. All of it is. All of it. And he knows he's sheltered by it because his term ends in May of 2026. He ain't doing nothing. He knows it. Trash ass nickel.
Well, what he's going to do, I think what we know for sure, he gets out in May. So you can almost bet that that the interest rates are going to go down, because whether he decides it in the next meeting or he waits until May next year, either way, the rates are going to come down because the next Fed chair is going to immediately drop rates.
Exactly. That's exactly what's going to happen. Exactly what's going to happen, guys. That's what's going to happen is the Fed chairman is going to, the new one is going to drop the rates. And I believe with the coupling of rate drops, right, as well as cryptocurrency, that whole play when it comes to them resetting the rewriting the financial system, I think in 2026, man, it's going to be a boom, Cliff. It's going to be a boom. I mean a boom, and because the banks can leverage the fiat currency as well as the cryptocurrency via new debt to lend out at competitive rates. You agree or you disagree?
Yeah, I mean, it's the crypto side is going to be a monster, because what's going to end up happening is you're going to have more demand on the dollar than you ever have had in the history of this country. Well,
yes,
besides probably World War II.
Yes,
because every person, why, if you can have a wallet, that's easy. It's on your phone. Cool. You can pull it up, crypto wallet.
Yeah.
Why would you not have dollars?
Correct.
Why? If you're in a lot of other countries, even France, even Germany, their currency goes up and down. You can own yours in any one you want.
You can.
And the smart ones will learn how to actually trade it and not just hold the dollar, but say, hey, I think this other country is strong. Australia's dollar is getting stronger. Or for example, the Canadian dollar is getting weaker. I could short that in my account. So it's seeing my value of the dollar go up.
Correct.
So, man, a lot of it's crazy, but Powell needs to go. He needs to just drop out. He ain't done nothing. He might as well leave. We're not gonna see a difference.
We're not. This guy's trash. I said to his face, you trash. You horrid. You're a coward. He's a coward. That's all he is. I said it once. He's a coward. If you're making decisions based on your damn emotions, get your little soft. I'm sorry.
I think he's scared of action. Like he's worried about, if I drop it and inflation goes up a little bit, it's like, man, you got to be more of a game player to say, if it goes up a little bit, wait a couple months. If it shows to be strong, so for example, let's say he drops it a half a point. Let's say he drops it a whole, something dramatic. I'm cutting it a point. Cool. If inflation goes from 2.7 to 3.1, is that really a crazy change?
I think you said it best. Let's say, for instance, he does lower the rate, right? Lower the rate. I said half point. But half point. And there's an inflationary event. Can he not call an emergency meeting and drive back up? Right. I mean, that's called being active, proactive. Guys, we're going to go ahead and lower the half point. If we see some inflationary events, we're going to call a meeting and hike it back up just to be safe. Everybody's cool. That makes sense. No problem. Cool. Yo, guys, I'm going to be a little aggressive and go down 1 point. But if I see something go, if you see something go up, I have to call an emergency meeting and do that. The person will say, that's fine. No problem. Let's do it. That's rational. Would you agree, Cliff? Or you disagree?
Exactly. And he would be able to justify the higher rate, saying, I did drop it.
Yeah.
We had inflation. We had a much stronger inflation. But but the thing is, if he drops it and we get minor inflation, I mean, like I said, 2.7 to 2.9.
Yeah.
But you dropped it half a point. That is well worth the economy moving.
Correct.
That's better for the economy. You're going to keep jobs better with lower prices coming in, and that 0.2% inflation, that's nothing. That's a rounding error.
Nothing at all. But again, like I said, he coward. He a coward. That's my opinion. If you don't like it, I don't care. It's my opinion. He's a coward. He's a coward. Now, Cliff, let's go on. We've given President Trump's response. I mean, if you want to listen to it, just go listen to it. We've given his response. Now, guys, let's move on to the next thing. All right, guys. Wall Street, y'all. Wall Street, they making some moves, y'all. Tell me why Wall Street, guys. Wall Street is liquidating properties. And it smells, Cliff, a lot like 2008 again, brother. About 2008 again, because the same thing happened then. You had idiots out there trying to play big investor that didn't know what they were doing at all, Cliff. Man, let's hear what's going on, man, in certain cities, bro. And then you and I can respond to this, y'all. Here we go. Let's get it in.
In this video, I'm going to show you how much home prices are now dropping in these neighborhoods that Wall Street is leaving. And I'm coming to you right now from the south side of Atlanta in College Park. This is one of the top 5 areas where Wall Street landlords bought up homes during the pandemic. And they caused the prices in neighborhoods like this to skyrocket. Values went up as much as 115% over 5 years, but now values are correcting because there's this massive sell-off. And this is a troubling sign. This is a troubling trend for the housing market, everyone, because while it's good that Wall Street is selling and that's going to create more affordability, it's a signal that's eerily reminiscent of what we saw in 2007, 2008, right at the beginning of that last crash. Because you can see some of the homes here in College Park, when you look at on Zillow, these homes went down 60–70% in the last downturn. Some of these houses sold for $30,000 or $40,000 the last time Wall Street decided to leave this neighborhood. And now, data on Reventure app is showing that values are down 7% year over year already, and that the supply of homes for sale is through the roof. Now, this might be a little confusing to some of you because the conventional narrative is that Wall Street is buying up houses and making home prices more expensive. But that was really the narrative of 3 or 4 years ago, and now that narrative is shifting into reverse, with data from Redfin showing that investor purchases in the Atlanta metro have dropped over 60% from peak. Look at that decline in real estate investor purchases in Atlanta. And the thing about it, everyone, is that a lot of those purchases were concentrated in neighborhoods like this. So when investor purchases drop 60% in the Atlanta metro, what it's really saying is that these zip codes on the south side of Atlanta, they had investor purchases drop by even more, and it had an even bigger impact on the market. And some of you who've watched my channel over the last year, this might not be huge news to you, because you've seen me in Florida showing you the investor sell-off in Florida and how home prices are going down in Florida. But what I think is fascinating is the fact that this investor sell-off is spreading now.
Yes, it is.
It's spreading to metros like Atlanta. And I have a feeling as I go along this road trip over the next couple weeks to other markets in the Southeast, I'm going to find even more of these real estate investors selling. And let me just explain to you all the relevance of this, right? The relevance is that these investors, they are getting out of the market for a reason, right? They're seeing something in real time on the ground. And if you watch, other real estate investors on YouTube, they talk a lot about this. The fact that the rental rates are no longer growing the same way they used to. In fact, the rents here in Atlanta are going down. The fact that property taxes are surging, insurance rates are surging, and this combination is making it no longer profitable to be a real estate investor in a lot of markets, especially with interest rates and mortgage rates close to 7%.
Yes.
And I actually just found a listing a couple blocks over, everyone, that I want to show you all. This is a house for rent, and it's owned by an investor out of Seattle. A Seattle entity bought a house in Atlanta in 2022 for 320 grand. Then they put it on the market for rent. Now, they originally had it listed for rent around 2,300 a month. Then they cut it all the way down to 1710 a month. It's on the market now for 1710 a month. It's a leasing special. We'll see if they get that rent. But what's amazing about that rental cut, everyone, is that when you do the math on how much money that investor's making, it's barely anything.
It's 3%.
Because say they get that 1,700 in rent. Let's do some math. Well, that's 20,000 a year in annual gross revenue.
Yeah.
Then you got to subtract your 10% vacancy loss.
Correct.
Then you got to subtract your $4,500 property tax bill. Then you got to subtract maybe your $2,500 insurance bill.
Damn.
Then you got to subtract your 5% management fee, as well as some miscellaneous costs for maintenance and utilities. And pretty quickly, wow, that investor is going to be making less than $10,000 a year unlevered on that property when they paid $320,000 for it. That's a 3% cap rate. That is not good, everyone. A 3% cap rate. What that means is that they're only getting 3% a year return on the rental property they bought, and that's not even factoring in their debt and interest costs. When you factor in their debt and interest costs, which I assume there are, they could be losing money on that house. And
Cliff, man. We got it, man. What you think, Doc?
Man, we created these conditions. We kept interest rates so low that now the economy functions really real estate functions on that, because what happened was we got hit twice. We got hit with high interest rates and inflation. So the property prices went way up, and then interest rates went way up. So now the reason why they're falling is just demand. There's just nobody can afford the higher prices, right? So it's not that the value of the houses are going to really come down all that much. It's really going to be the buyer demand is going to come down. Is what's going to end up happening. So you're going to see more people stay where they are and have and that's just less people moving. That's less opportunity. You probably, if you were to look at this in the statistics, you probably look in the I probably look at U-Haul rates and see how they are now compared to where they were several years ago, and go, ooh. U-Haul's down 40%.
Yeah.
There's just not many people moving like there were, because it's just not many transactions. People aren't moving out of apartments into houses into apartments. They're staying.
Exactly. And a lot of people, what they're doing is they're downsizing. A lot of people just downsizing, guys. I would say I'm not surprised of what I saw concerning Atlanta, Georgia. Atlanta, Georgia is very inflationary right now. It realistically is, because a lot of hedge fund companies in Wall Street were coming down there and buying properties. Now, let me kind of give you a little bit of some details concerning these hedge funds from Wall Street. This is a person sitting behind a desk that knows nothing about Atlanta at all, just with a blank check, just buying properties at bulk. And they're paying retail or above retail because they have money, which is really your retirement money, right? They have to deploy. Got to deploy. So their whole thing is to deploy the capital to say that they made an investment, right? And they buy at retail or above retail, sometimes 25% above retail. That actually happened here in Forney, Texas, for new construction properties. That happened, and the buyers were a Wall Street company. That's what they're doing. And what they're thinking is, we could probably sell it, but if not, we could back into leasing. But as you saw, rental rates are going down significantly right now, because that's what the market is calling for. People are not selling their homes because of the fact that, why would they leave a 2 to 3% interest rate to go to a 7-8% interest rate? Why would they do that? The only way it makes sense for them to sell right now is if they sell and go lease if you're a seller. But in order for you to be a seller, you have to have a buyer. That buyer has to be willing to do a couple of things: accept a higher interest rate, or convince the seller to give some concessions to buy down their rate. And they probably get down to maybe 5%. Maybe there. So I'm not surprised this actually happened. I expected this to happen because Wall Street always buys real estate dumb. Because then there's no boots on the ground. They're not Cliff and I. They're not. They're not doing this actively every day. They have somebody that has a blank check up there, sitting behind the desk and reading some type of prospectus that has nothing to do with what's going on the ground, and boom, and they're making this. Now get this: if they lose money, they're not losing their money; they're losing your money. Let me say that again: if they're losing money, which you saw, 3% cap rate, and most likely it's going to be a negative cap rate, that's not their money; that's your money because it's your retirement money. They'll come in. This is the backup plan. And a sister company that they actually own with their own money would come out and buy that property below wholesale or at a discount. You take the L, they get an asset on their books below wholesale. Who wins? They do, not you. Let's give it to 1,000 with you. That's what's going on here. This happened in 2008, and now it's happening again in 2025. Now, what can Trump do, or what can they do concerning this? I believe that this cryptocurrency play, if done the correct way, could alleviate some of that pressure. Because in 2008, all they had was the printing press. So they had. So if you agree, man, you disagree.
No, I agree. I mean, it's it's just a unique situation, man. COVID messed up everything, and we handled it so dumb financially. We spent way more money than we should have.
Yep.
Caused inflation, then had to raise interest rates to stop the inflation. Then we keep the interest rates too long, slow down the market 2 for 2. I mean, I'm almost feeling that like the Fed almost causes the issues that it's trying to solve in a lot of ways by trying to time things you can't time.
Correct, brother. I think the Fed believes that they have a unlimited paycheck, unlimited amount of funds, not because they believe that. It's because of the fact that they know that you don't know that. They know that from a education standpoint, us as investors, but the lay person doesn't have a really high financial IQ, and I mean it respectfully. This is the reason why when I ask you a question concerning your retirement, what is your retirement invested in? You tell me, I don't know. So how can you have all this money in your retirement account, not know what your cash on cash return is, not know what your rate of return is, and you can't tell me what you invested in? But you're making money though. How does that make sense? Do you see how they can use your naivety and go out and buy these properties at retail or above retail as real estate, lose on the investment, get it at a discount rate with their own cash, and you left holding the bag? Cliff, am I off? Let me know.
Nah, you gotta. But I would say this: we're gonna see the market is going to change because we got a lot of confluences.
We do,
right? With a lot of things intersecting with each other, right? But I think we're in a business-friendly environment.
We are.
I really do think if interest rates were, if a mortgage was at 5.25, Dale, what would you think the market would look like? I think you'd probably see 30% increase. I'm gonna be moderate, 25% increase, easy from where we are now.
You would.
You would see more transactional because people at 3.5 going to a 5.25. Maybe it's probably about depending on the price point, but the average home is about $400,000, $450,000. That would put roughly $400 more a month.
Correct.
So a little bit of pressure. But where I see it is the rich are getting richer at a substantially faster rate because all the efficiencies in the market are going to the top, because when you own a multi-billion-dollar company,
that's right,
and you get 20% more efficient because of AI,
correct,
all those cost savings flow to you. They don't flow to the average worker. You're making the same amount of money that you would be before, whether the company grows or not. Because I'm looking at the stock market, and I use it as a barometer because that's where the money is flowing. That's where the rich have their money.
Correct.
And you can see it's flying. The companies are seeing it and doing company buybacks. And I think you're going to see this over the next... Look at this, Dale. I'm looking at a 1 year from the S&P 1 year return, Dale. 1 year in the S&P. I'm gonna give you one chance. What you think the return? If you would have put your money in the S&P 1 year ago from today, what do you think your return would be?
I'm gonna guesstimate high. 10 to 12%.
20%.
Woo! I was low.
In 1 year. Now, if you're wealthy and you got 10 million, you made $2 million in a year, 200,000 a month in the stock market, because all the efficiencies of AI are going to the top.
Yeah.
And we're going to continue to see this. And I think that this housing is going to, because I think the houses from 500 to 800,000, you're going to start seeing those be very negotiable.
Yes, they are. Yes, they are. Yes, they are. We are actively looking ourselves, and we're purposely waiting because I believe that the real estate market is going to come down. The pricing is going to come down. I think another 10, 15%. Is it aggressive? That's aggressive. That is very aggressive. Because of the fact that the variable that I'm putting kind of linking that on is people's DTI ratios. It's too high. The only way that actually makes some sense, Cliff, is if they do what the government is one of two things: goes from 30 to 40 to 50 to 60-year loan mortgages, which is not unreal. That is real. That can happen because I'm already seeing 40-year mortgages right now. Or number two, they raise DTIs over 50 to 55, 60%.
Yeah, no, I see what you're saying. You would have to, because the wages are not increasing.
No, they're not.
But the value, so you're saying it has to align. But I'm saying it don't have to align if you don't have to sell.
You're right. But I think people want to sell though. They want to get some liquidity out because a lot of people are cash strapped right now. They cash strapped.
Yeah, I see what you're saying. There's a lot of equity still in the properties because it went up so much.
Yes.
Some areas better than others, right? Like I saw some homes easily double in value. Yeah, now I see what you're saying, that they got to come down to align with what people can afford. But if you don't have to sell, if most of the market does, so you would look at foreclosure rates. If foreclosure rates are low, that means people don't have to sell because, again, they're paying their mortgage and their rent like it's 2018, 2017. Right. They're not paying today prices. They only have to pay today prices if they sell, and they're not going to because they can only afford 2017, 28 prices. Correct.
That's what I'm actually seeing, man. What I'm actually seeing is, but here's what I think that's what's going to happen. Is I think that the government's going to raise that DTI ratio. They got to. Because this is alleviating the pressure. That cryptocurrency play is going to allow for them to assure the banks, hey, we know we're asking you to take a risk here. We'll stop gapping. Does that make sense?
Yeah. And so you think another 10 to 15%. So you're saying the average home is about 430,000. You're going to say that's going to go down to 380, 390.
Potentially, yeah.
Or about 390. Man, that's a huge drop. That is a huge drop. Yeah, I mean, it's going to depend. I think you're going to see an offset of that. So I think you normally would see maybe 15%, but I think you're probably going to see closer to maybe 5, just because you're just not going to see a lot of transactions. People just won't sell rather than trying to sell cheap.
Maybe. I could see that. Potentially. I just think that people are going to want to. They're going to want to sell cheap. They're not going to want to sell cheap. They're going to want. If they sell now, they will give a significant concessions. I'm seeing concessions 5-10% right now.
Oh man, I'm doing appraisals and I did one. And Dale, this got me thinking too. This is wild. It was a property built in 2021. Tell me why a property built in 2021 is doing a short sale.
Yes, sir.
A short sale. I think they did it for 420. something like that. 420, 430 is when they bought it, and I'm doing my evaluations at 380, 390. On the comparables that I've selected, every single one of them has concessions of 10,000 or more.
Told you.
Every single one, which I'm guessing is buy down rates. Everybody is just going. When you look at the price on the market, the first thing you would do is go to them and say, "I'll buy your house, buy down my rate."
Yep.
I need you to buy it down to 4%. That's what all the new constructions are doing. Go look at every new construction company. They're all saying, "Hey, we'll buy it at this price. We'll buy down your rate down to the 4s." I'm seeing that pop up more.
Yeah. Now, sellers, listen to me. If you're a seller, listen to me right now. If you're wanting to sell your property at a high or a top of retail price point, I want you to memorize this term that I'm going to tell to you. Seller finance. Or subject to investing. Be the bank to somebody. You're paying a 2% interest rate right now, right? If you want to get rid of the property, just assign the payments over to an investor like me and Cliff. We'll pay the payments for you, and we give you money for you to move out. Right? So that you're done with it. If you want some profit, right? Seller finance the property out at a retail price point. You most likely owe less than what you're selling for, most likely, right? Seller finance it out. Get a 3 to 5% down payment up front, right? And then your rate may be 5-6%. If you're paying 2%, you're making a delta of 4% on a higher amount. So you're making cash flow right up front, which is great on a monthly basis, and also you actually collected a down payment. Was it as much as you wanted? No. If you want to complain about it, sit on it, and you pay for it. Just saying. If you want top of retail right now, you got to think outside of the box. You're going to have to do it. Again, subject to investing, right? Or seller finance. Those two terms. Memorize those terms. And if you have a property that you actually want to sell and it makes sense, Cliff and I will take a look at it. No matter where it's at. We'll take a look at it. Very simple, Cliff. Am I right, Cliff, or am I wrong?
Yeah. I mean, any deals, definitely take a look at, see what's going on. Man, it's just a different world out there. I would say this. One thing I did notice when I go to a lot of people's houses, one business I would like to get into is storage facilities. I probably see 80% of the houses I go to, the garage is filled with just stuff. 80%.
Wow, really?
Easy. So wow. I'm like, the storage facility business, you let me know, Dale, man. To me, it might be genius just to try to raise as much money as possible and buy one storage facility, one really large, and then it's easy to manage.
Yeah.
You do a quarterly meeting with everybody, your investors. Hey, this is the revenues, how it looks, and negotiate to where you only, you make a little bit of money, but on a $15 million storage unit.
Correct. It's
simple.
Sir.
It's going to keep going up in value. Stuff just keeps accumulating. Yep. I mean, it's a great business.
Great business model. And there's very little foreclosures on storage facilities. Very few.
I'm telling you, you wait till you get a good opportunity, maybe on one that had a fire or something like that. Buy it, put 20% down, fix it up, and just hold that bad boy with some investors.
Yes, sir.
Cash flow for the next 10, 20 years.
Yes, sir, man. You got it, man. But Cliff, man, I think we're giving them some pretty good counsel today. What you think?
Man, yeah, I think so, man. We're gonna be back next week, man, with some more info.
We are, guys. Now, guys, before we leave real quickly, guys, we got to say it, guys. Let's talk about real quickly. You have a licensed appraiser on the screen. All right. That is uncommon. Cliff is a licensed appraiser. not only in the residential, but also in the commercials. You're getting that button up as well. Also, Cliff, man, tell them about you and your service, man. Talk to the people.
Yeah, so you can see the website there, hunterappraisal.com. Doing it in multiple cities in the state of Texas, and even doing consulting. So I do get consulting assignments for just different people who are looking at building subdivisions, raw land, any type of developments, or even just renovation projects. So just go to the website, give me a call. You'll get my team on the phone. We'll be able to talk to you, get you additional information that you're looking for, and see how we can be able to help you out. If you're just looking for an appraisal or consulting, just go to the website, give us a call, fill out a form, and we'll be able to help you out.
Sounds good. Sounds good, man, guys. You see it on the screen, hunterappraisal.com. And lastly, guys, before we get off, guys, hey, if you're wanting access to the distressed property ebook, guys, it's very simple, guys. It is free. Doesn't cost you a dime at all. Go and download the distressed property investing ebook. It is free. You make money when you buy, not when you sell. Specifically, what me and Cliff talked about concerning what's going on with the price points going down on properties, right? Again, this book talks about how you can locate, find, and vet distressed properties in your city, county, or state. It is free. Click on the link below, scan on the QR code, or if you can't do any one of those things, very simple. Direct message me the word real estate, and my team will get you out the link today. It's free. Just want to give you guys the information, man. Cliff, you want to say anything, man, before we get off? We get off at all, big dog?
Nah, man. Same thing I say every week. You're one deal away. So contact us. See what you can learn. Get the book. Read a little bit. None of this was available when I got started. When Dale got started. So take advantage of being able to learn from somebody. And man, you one deal away.
Just one deal. Again, guys, we decided this also one scan on the QR code, guys. Hope you enjoy the ebook. Again, it is free. The biggest thing for me and Cliff is we started this podcast because we wanted to be able to give back to give back to the community of what we learned. We've learned a lot. Cliff, we've done a lot of real estate at big dog.
Oh yeah.
A ton. One of the ones that I really want to talk about real fast is you remember the one we did in Florida? The mansion?
Oh yeah.
Guys, this is the brilliance of having a licensed appraiser and a GC on your squad, right? Who could run a GC team. Cliff, how much do we have budgeted for that renovation?
Man, what was it? 600, 700,000?
How much do we actually spend?
Like 3-4 something?
$300,000. So how much did we pocket, man, out of the renovation?
Like $400K, $300K.
So we were able to pocket $300,000 of the renovation budget. That's money we took to the house. And Cliff, did we make some money when we actually acquired it too?
Oh yeah, that was a beast.
Made another $200,000 when we bought it because we understood how to locate distressed property. So guys, again, scan on the QR code, DM me the real estate, and go and get you a copy. But guys, man, thank you so much for your time. God bless you, man. Cliff, man, what you say, man? Each time we get out, big dog.
Man, we're one deal away. Peace.
One deal away, guys. God bless you guys. See you next time. Peace.
Okay, so you did fixes and flips first, or were they? Now it sounds like you're more buy and hold. Okay, so you're wholesaling first. Okay,
because I was broke. I had no credit. I had no money. So I had to get some money coming in. So I learned how to do wholesale.
And you were doing wholesaling at the good time too.
2000.
When it wasn't so saturated. There was.
I kind of saw the debacle coming. Okay. It didn't make any sense. I was like, wait a minute, how can you lend out to retail buyers 99.7%?
Yeah.
Just a little bit of a down tick. It's insolvent.
And you got to remember, in some states, because I lived in Florida at the time, you could have loan to value above 100% of your property.
Right.
The first property that I bought, it was 110%. We left the bank with like $30,000.
Yes. Yeah. Yes.
It was amazing to me. I was like, why am I not doing this all the time? But then clearly 08, 09 let me know why people shouldn't have been doing that all the time.
08, 09, that's why I made that lion's share of my money.
Wow.
People
Okay.
were actually running from the cows. I was running to it.
Of course.
Because I saw it was coming.
Okay.
A lot of my business colleagues back then were buying flippers.
Yeah.
I didn't think it was wise for me to share 50% of my profit with Uncle Sam. He didn't do no work.
Okay.
So why would I give him free money?
Of course.
Okay, how can I make sure I'm still legal but keep the lion's share of the cash flow.
Of course.
So I began studying the tax code with my accountants and CPAs, and I said, okay, I'm going to buy a whole lot of properties. Now watch this. I actually buy a lot of properties. And I take home money when I actually acquire it every single time.
Okay, you need to break that down just a little bit.
If you wanted to know how successful real estate investors make money with their acquired real estate and not when they sell it, click on the link below or swipe up and download our free ebook, Distressed Property Investing. The blueprint is in the ebook. Stay blessed, holler at your partner, and download the ebook today.
Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Bless God, give thanks. Big God, big grace.